One of Nvidia's biggest customers has just been accused of being a fraud in a major new short selling report. This is the latest piece of stock market news we need to be paying attention to. And I'm going to show you in today's video why it's a threat, not just to Nvidia, but also to the US stock market as a whole. Supermicro falls as Hindenburg takes aim with short report. Accusations focus on accounting practices and transactions. This Bloomberg article goes on to say that Supermicro Computer Inc. shares fell on Tuesday after Hindenburg Research said it short the maker of server equipment, which became a tech market darling as a major beneficiary of the boom in artificial intelligence. The stock fell as much as 8.7% after Hindenburg's research report, though it paired much of that decline and closed down 2.6%. Hindenburg, the firm run by Nate Anderson, wrote that an investigation into the company revealed glaring accounting red flags, evidence of undisclosed related party transactions, sanctions and export control failures, and customer issues. A spokesperson for Supermicro said the company does not comment on rumors and speculation. So the company's not prepared to comment on the short report that's just been put out calling them a fraud, but actions speak louder than words, and actually their actions were a lot worse than anything they could have said regarding this report, and you're going to see why in a moment. And in fact, those actions caused the stock to drop another 20%. So what exactly has this got to do with Nvidia? Well, the answer is quite a lot, as it turns out, because if we look at this Bloomberg screenshot, you can see Supermicro Computers is one of the biggest customers of Nvidia. And in fact, it makes up 8.62% of Nvidia's total revenue. And I'm going to show you in today's video exactly why that represents such a risk to Nvidia's future earnings. And if we head back to the Bloomberg article, what do we have here? In 2020, Supermicro resolved an investigation by the US Securities and Exchange Commission into its accounting and disclosures for the fiscal years 2014 to 2017 by correcting its financial statements and paying a penalty while promising not to commit such violations in the future. So this is a company that's already been fined by the SEC in the past for want of a better phrase, cooking the books. And they've promised not to do it again. So would they be so stupid as to do this again? And if we jump over to this CNN headline, the answer many investors have to that question is yes, they are stupid enough to do it again, because Supermicro shares fall 19% on filing delay. Shares of Supermicro Computer closed down 19% on Wednesday after the company announced it would not file its annual report for the fiscal year with the US Securities and Exchange Commission on time. SMCI is unable to file its annual report within the prescribed time period without unreasonable effort or expense, the company said in a release. Additional time is needed for SMCI's management to complete its assessment of the design and operating effectiveness of its internal controls over financial reporting as of June 30th, 2024. So the company SMCI is not prepared to comment on the short seller report because it amounts to speculation. However, it did decide shortly after this to pull and delay filing its annual reports, stating that it needed more time. And this is why the stock fell another 20%, which is actually more than twice it originally fell on the report itself, because investors took this as a sign, well, look, if your books are actually up to scratch, why do you need more time? Why are you delaying the filing of your annual report? So let's jump over to the report itself, and this is the Hindenburg Research headline: Supermicro, fresh evidence of accounting manipulation, sibling self-dealing, and sanctions evasion at this AI high flyer. Our 3-month investigation, which included interviews with former senior employees and industry experts, as well as a review of litigation records, international corporate and customs records, found glaring accounting red flags, evidence of undisclosed related party transactions, sanctions and export control failures, and customer issues. The report points out that in 2018, Supermicro was temporarily delisted from the Nasdaq for failing to file financial statements. By August 2020, the company was charged by the SEC for widespread accounting violations, mainly related to the $200 million in improperly recognized revenue and understated expenses, resulting in artificially elevated sales, earnings, and profit margins. So the company wasn't just fined by the SEC, it was actually delisted temporarily. And if you want to know whether the company learned a lesson, have a look at this. Less than 3 months after paying a $17.5 million SEC settlement, the report goes on to say, Supermicro began rehiring top executives that were directly involved in the accounting scandal, per litigation records and interviews with former employees. A former salesperson told us almost all of them are back. Almost all the people that were let go that were the cause of this malfeasance. And according to a lawsuit filed in April 2024, Supermicro waited only 3 months after the SEC settlement before restarting improper revenue recognition, recognizing incomplete sales and circumvention of internal accounting controls. Even after the SEC settlement, pressure to meet quotas pushed salespeople to stuff the channel with distributors using partial shipments or by shipping defective products around quarter end, per our interviews with former employees and customers. And so when you have a company which is showing as much growth as SMCI has been versus the average industry growth rate, and that company has previously been fined and delisted for inflating its earnings, and when this company is being accused by its own staff of rehiring all of the people who are responsible for its previous earnings manipulation, when a new report drops from a reputable short seller, you do have to ask yourself the question, are SMCI at it again? So if the short seller report from Hindenburg is correct and SMCI are inflating their accounts amongst other things, why is this such a big risk to Nvidia? Well, we've already seen that SMCI is the third largest customer of Nvidia, making up over 8% of Nvidia's revenue. So if we look at this extract from an article on Nasdaq.com talking about risks around Nvidia's future growth potential and earnings potential, it states also big tech companies are working on their own chips as they try to cut down their spending on buying them from Nvidia. So that's one risk to Nvidia's growth and earnings. But notably, it states Nvidia's revenues are also quite concentrated. And one single unnamed customer, which UBS believes is Microsoft, accounts for almost a fifth of its revenues in the fiscal year 2024. And we know, we just looked earlier on at that Bloomberg screenshot, it is in fact Microsoft, which is sitting at just under 20% of Nvidia's total revenues. The article goes on to point out that such revenue concentration is always a risk, and if large customers cut down on buying Nvidia's chips, it could have a significant impact on its growth. So we've just established we're in a situation where the third largest customer of Nvidia, responsible for over 8% of its total revenue, may be inflating its numbers. And if we go over to Nvidia's latest quarterly report, you can see that the issue here is that Nvidia has accounts receivable at 14,132 in the latest statement, which is an increase of 14.29% quarter on quarter. Now, accounts receivable represents items, services, goods that have been sold, in this case by Nvidia, to its customers, in other words, generating revenue, but using credit. And so what we're looking at here is we're looking at the accounts receivable, which is essentially the revenue or the sales that Nvidia has made to its customers. And bear in mind, SMCI is the third largest customer. It's made these sales on credit, so it hasn't actually been paid yet for these sales. And if we go and have a look at total sales of Nvidia in the latest quarterly report, you can see that total sales amounted to 30,040. So if we take the accounts receivable and we get a ratio compared to its total revenue, we're looking at about 47% in terms of accounts receivable compared to the total revenue of Nvidia. So think about the risks here potentially for Nvidia. Put yourself in Nvidia's shoes, or better still, think of an analogy. You own a bank, somebody comes into your bank, they tell you they're a professional footballer, they give you personal statements, you read through them, you say, okay, fine, yeah, I can see everything here, you've got tons of money. So what I'm going to do is I'm going to give you a loan. I'm going to give you a loan, actually it's the third biggest loan that my bank is going to take out, only to find that person is not a professional footballer at a later date, and that they are inflating their financial statements. Wouldn't that pose a significant risk to your bank, because it's a liability? You're owed money based on that loan to that person, and the risk is you might not get paid back. And Nvidia finds itself in a very similar situation where it has accounts receivable, a large amount of accounts receivable, especially compared to its revenue. And now its third biggest customer, of which I would assume has quite a lot of credit with Nvidia, and Nvidia is waiting to be paid for, I would imagine, quite a lot of orders from SMCI, only to find out that that company is totally inflating its financial statements. So the big risk here for Nvidia, because of what's going on with SMCI, is the risk pertaining to its accounts receivable. So why is this SMCI risk to Nvidia, potentially through the accounts receivable, such a big risk for the stock market in general? Because as you can see from this Yahoo Finance article, the chip maker accounts for, and we're talking about Nvidia here when we are talking about the chip maker, accounts for about 6.6% of the S&P 500, making it the second biggest company in the broad equities benchmark after Apple. It also has a more than 8% weighting in the Nasdaq 100, and it makes up 14% of the Philadelphia Semiconductor Index. So this is why SMCI, first and primarily, I would imagine through the accounts receivable, poses a significant risk to future earnings of Nvidia, and why if we start to see a knock-on effect from what's happening with SMCI to Nvidia's earnings, this has broader implications for the market, primarily at an industry-specific level with the semiconductors, but also in the Nasdaq with that massive 8% weighting and the second largest weighting in the S&P 500 behind Apple at 6.6%. So keep an eye on this story, as I'm sure it will develop over the next few weeks, because it does have a potential for a dominoes effect from SMCI all the way up to the US benchmarks. So that is it from me for today, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the GMT training room each day, where I look at the best markets as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge hedge-trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge hedge-platform is included with every GMT membership.